From New York City to our viewers worldwide, Bloomberg Real Yield, it starts right now. Coming up, Chair Powell, the taper and the groundwork for starting this year. The bond market adjusts, taking yields on a ride and measuring substantial progress. An eye on the payrolls report next week, plus Cleveland Fed President Loretta Mester speaking with our very own Michael McKee in just a few moments. All that still ahead, but first, Chairman Powell taking center stage. Here's what he had to say.
At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year.
And that was Jay Powell, Matt Diczok, Bank of America, Columbia Threadneedle's Gene Tannuzzo, and Jeffrey Elswick of Frost Investment Advisors joining us right now. Let's get this conversation going right now, guys. I'll start with you, Gene. We got that message right now of a possible taper, possible in 2021, and of course with enough conditions here that it could be pushed back into 2022. Was this what you expected?
Well, I think it's very consistent. I mean, I think if we take apart what we think perhaps should happen and just listen to what we think will happen based on what the consistent chorus of Fed speakers have been saying since June, this is very consistent. We are moving towards a taper as the labor market improves. It's not about inflation. Inflation has checked the box for a long time now. This is all about the labor market, and it's gotten a lot better. So I think we are looking for a taper later this year. I think it's one that will play out over a series of Fed meetings, and first they have to change their language in their statement. We would expect some move in that direction in September as you move towards an actual taper at the end of the year.
Jeffrey, the message was largely in line, I guess, with what Powell has said in the past. It was largely in line with the minutes from the last meeting and largely in line with some of the commentary that we've heard from various members of the Fed, including Loretta Mester here. When you look at the knee-jerk reaction, at least over the past 3 hours in the bond market, does that fit with your expectations? Does it sync up?
I think by and large it does, yes, Romaine, in that with the idea that I think some of the markets, including myself, were actually expecting them to announce a taper in September and then to start in October. So now that it seems fairly clear from the chairman's comments that, there's good odds that it's going to go to perhaps January with a December announcement, that would lead to a conclusion of a steeper curve ultimately. But right this second, I think that surprised some of the markets unless you have this rally going on. Having said that, today's rally, since the news came out, is a little bit of a reversal of the sell-off of the last few days leading up to the meeting.
Yeah, absolutely. Matt, jump in here because, we heard from the Cleveland Fed president in the past prior to today, and she certainly talked about the idea of getting this taper started, not only this year, but the idea of ending it sometime by the middle of next year. We heard a lot from Powell today about the potential for starting it. We didn't necessarily get a lot of guidance here on the pace of that, when it would actually end here. What's your general expectation?
No, we didn't get an idea of the pace of when the slowdown was, but it definitely hit it right down the fairway in terms of leading us to likely a November start for the taper. If you go back to 2014, what happened is you saw it took about 10 months when the taper started to when it actually finished. So that's kind of the ballpark estimate right now. So that puts you, if they actually start in November, you roll back a couple of months, then September is sort of the wind down. It's possible if economic conditions continue to improve, you could have a shorter taper this time. It could be potentially 8 months. So that middle of the year to back end of the year ending for taper is probably where he's at right now. I would say, by the way, he hit the ball right down the fairway. Great job in the speech today in terms of setting up the taper. No real new information. Flexibility to go November, September off the table. Could push it back if we see a weak employment report. But on balance, to me, a lot of his comments aired more on the dovish side in the speech than I would have expected slightly.
All right, Matt Diczok there, Bank of America Private Bank Fixed Income CIO, Jeffrey Elswick of Frost Investment Advisors, Gene Tannuzzo of Columbia Threadneedle. All three of these gentlemen will be sticking with us here for the length of the program. We are waiting, of course, to hear from Cleveland Fed President Loretta Mester, where she, of course, will get her thoughts not only on what's happening here with regards to the start of tapering, but maybe to the pace as well. You're looking at the knee-jerk reaction right there on your screen. Let's go to Michael McKee with Loretta Mester.
Well, thank you very much. We are joined by the Cleveland Fed Bank President, Loretta Mester, and we welcome you to Bloomberg Radio and Television Worldwide. Thank you for making time for us. We don't have the beautiful backdrop we normally do, but it's nice to see you virtually anyway.
Well, thanks for having me, Michael.
What'd you make of Jay Powell's address today? Is he now on Team Mester, Team Let's Taper?
Well, I don't know whether he's on Team Mester or I'm on Team Powell, but I think we see things pretty similarly. I mean, the economy has made a lot of progress. I think that's the great thing about what we did early in the pandemic. And now the question is, is it time to step back from some of that extraordinarily accommodative policy that we put on, and in particular, the asset purchases? And the criteria that we put in the statement about what would it take for us to begin tapering, I think we're pretty much there. Certainly inflation, we made substantial progress since December of 2020. And I think that we've also made substantial progress on the labor market. We're going to get another labor market report before our next FOMC meeting, and I'm going to be very interested in seeing that. The only real risk here is whether the Delta variant is going to cause more of a pullback in demand than I'm expecting. And of course, I'm going to be watching that. But I think basically we've met our criteria. And now it's a question of communicating in an appropriate way so that we can make sure that we're not surprising the markets in some way. And I think the chair did an excellent job today of sort of setting out the thinking of the committee.
Well, should people be thinking that the September 22nd FOMC meeting is a possibility for announcing a taper?
Well, we started out talking about it a meeting ago. Now we're going to be talking more at the September meeting. My own personal view would be that we want to use that meeting to sort of lay out some of our own thinking about the pace and the timing. And I'd be satisfied if we began tapering sometime this year. And I'm looking to try to end those purchases and complete them by the middle of next year. So I think we're all sort of in that ballpark, and we need to have that meeting in September to sort of codify our own thinking on that. But I think the bottom line is that I think we've met the criteria we put out, or we're very close to it in terms of both the labor market side and have already met the criteria in the inflation side. So, whether it's, September to start in November or November to start in December, I don't think that's going to make a material difference to the economy. I think the important thing and the important message is that we've met the criteria. The economy has momentum. There are certainly risks out there, and, we're going to be carefully watching both the inflation side and the employment side. And as I've said all along, and the committee has said all along, how the economy goes really is dependent on the virus. But, we now have vaccinations, and I think the outcome will be a lot different than it was earlier before the vaccinations were available.
Well, pretty much everybody on the committee has said that they would like to finish tapering before they even talk about tightening. You and others have said, let's get tapering over by the middle of next year. Does that suggest that you have some concerns about inflation and the possibility that you might have to start raising rates sooner?
No, I mean, the way I look at it is we put on the asset purchases. First we put them on because the markets were very disruptive and dysfunctional, and so it was very important for us to go in and purchase those assets. And then we left them on because the economy really needed that kind of very accommodative policy. Now the economy has basically improved enough that we don't really need to have those asset purchases, in my view, supporting the economy. Once we complete the purchases, then the second part of this is, okay, let's think about where the economy is going and calibrating our Fed funds rate. And, we've said the criteria in our statement of what we're going to need to see, and that is maximum employment, and on the inflation side, inflation at 2%, and then, sustainably moving above 2% for some time. So I think we have time, once those asset purchases are completed, to take an assessment of what the incoming data is telling us about the underlying momentum in the economy. And we're still going to be, consistent with our forward guidance. So, interest rates, I think, are longer down the road and not a topic for today. but to come after the assets are completed.
A lot of the analysis on Wall Street is using the term dovish taper for Jay Powell's remarks, because he did talk about still a ways to go and a lot of slack left in the economy. Would you characterize it that way? Are there still concerns that you might have to hold off?
Well, there is still risk out there in terms of the Delta variant and how much that will, affect demand. In my district, it certainly has, a lot of the businesses that I talk to, business people I talk to, they're concerned about it. They have maybe pushed out the return to the office because of the variant until that subsides a bit in the areas that are covered by the 4th District. But it really hasn't tempered demand so far. So it's a concern. People's attitudes are a little bit cautious, but it hasn't really affected activity. But we need to keep watching for that. In terms of the overall strength of the economy, even if we have some pullback in that, I think the economy will remain strong. That said, we haven't reached maximum employment yet, in my view, and there is still room to go on the employment side in terms of those criteria that we put out for our first liftoff of the funds rate. So again, I think the economy is in good place. I think policy is in a good place right now. And I think we just have to let the economy continue going, forward, and then we'll assess that need to raise interest rates as we go. But I think we're in a good path right now. It's just, let's see how the economy performs over the next, several months and into next year before we even think about where the interest rate needs to be.
Equity markets seem to like the announcement today, and the bond market has rallied a little bit. So I'm wondering if you are concerned at this point about asset prices and your contribution to them, and you would be relieved if we start going back down. I noticed you mentioned earlier today that you thought junk bond leverage was quite high.
Well, I'm always, very focused on what's happening in the financial markets, and I think that's appropriate. I think right now policy is really concentrating on what's going on in the macro side of the economy. And so those financial stability issues, I think we always have to pay attention to. I do think that there are some excesses. The real estate prices are frothy. You have the excesses I pointed out in the junk bond market. I think those things are we need to keep a watch for, but I wouldn't be changing monetary policy based on what's happening in the financial markets at this point. It really is an argument about what's happening on the macro side of the economy, and the sense that, we've made substantial progress since December. And so I think it's basically time to really assess the taper, start it sometime this year, and let those asset purchases, taper off and end in the middle of next year. And I think that's where I am in terms of where I view the economy going and the proper policy associated with that outlook.
In terms of the macro outlook for the economy that you mentioned, has yours changed at all? Where do you see inflation, growth, and unemployment now going into 2022?
Yeah. So I have increased my inflation outlook based on the numbers that have been coming in. So, I might have been at 3.5%. Now I'm probably 3.5% to 4% for the year. And that's also reflects the fact that a lot of those supply chain disruptions, if you talk to many businesses across many sectors, they all really said that, we thought that they would turn off earlier and abate earlier than what it's turned out to be. They're lasting a lot longer, and they're expected maybe even to last into 2023, depending on which sector you're in. So those are putting upward pressure on prices. The question is whether that upward pressure is going to raise inflation expectations to levels that are above what we're aiming for, which is 2%. And right now, I still think that inflation will come back down next year, but maybe it's more risk on that inflation outlook than I had before. In terms of labor markets, I think labor markets have improved better than I thought they would at the beginning of the year. And now, I also think that we're going to continue to make progress there, and we'll see better labor markets as, more people get vaccinated, as more people can re-engage in economic activity. And I think that's where I see things going in my baseline. There's always risks around there. The Delta variant, we see that in places that don't have vaccination rates that are high, we see Delta creating real problems for people. And so, we have to still be humble about our ability to forecast the virus, because the economy does depend on how the virus plays out. My own view is that we've learned to navigate the virus. We have a tool now, the vaccination, that can really, really help us get through it. And I'm hoping that more places will have vaccination rates that move up, and so that we can sort of continue to engage with the economy. But we'll have to see. And I think policy is positioned to be able to take the time to look at that.
Well, that's a good way to leave it, I think. Loretta Mester, thank you very much for joining us, the president of the Cleveland Federal Reserve. This is Bloomberg.
I'm Romaine Bostick in for Jonathan Farrell. This is Bloomberg Real Yield. Time now for the auction block. We're going to kick things off over in Europe with bond markets ending the week on a busy note. 6 issuers coming to market on Thursday alone. Weekly sales going to just under 30 billion euros. Back here stateside, investment grade issuance grinding to a halt in the U.S. Just over $3 billion in total high grade sales this week for borrowers coming to market. In the high yield market closing for the summer as well, but not before $34 billion priced in 3 weeks, making it the second busiest August on record. Matt Diczok, Tannuzzo, Jeffrey Elswick still with us here on the big program here. And Jeffrey, I'll start off with you here. We talk a lot here about all the hand rigging we saw this week and in the weeks prior about what type of demand we were going to see at some of these auctions. And the demand seemed to be there. And I'm curious that now that we have a little bit more guidance out of Powell as to when the taper could potentially start, whether that demand is going to hold up.
No, I think, Romaine, the demand will continue to hold up at least until we get closer to a period of time where the markets get a little uncomfortable about a potential sell-off in the bond market. But up until that time, I would fully expect that the auctions will continue to go well, pushed along both by foreign investors, as long as you have the dollar doing what it's been doing, as well as local or U.S. investors as well. So I fully expect the auctions to continue on for at least some period of time. There is this issue with T-bills and what's going on with the debt ceiling, but that's a little bit different animal.
Yeah, that's a whole nother sort of can of worms there that I guess the market's going to have to contend with down the road. Maybe not. Maybe Congress finally does its job. Matt, I mean, when you talk about the appetite here and how you sort of position yourself going forward here, what's your general take?
Our general take is that this is a place you want to take not too much risk at this point. You want to be balanced. You want to be diversified. We have seen a little skittishness in markets, not too much in fixed income. High yield did widen out 50 bips from its all-time tights. It's come back a little bit. But our general view right now is to maintain a quality, up in quality, prudent, diversified risks across spread products, right? Primarily investment-grade corporates. Again, a place you're going to get paid additional spread over time, more than your credit losses, but certainly not a time to swing for the fences. And unfortunately, even though I'm the fixed income guy, to be overweight equities versus fixed income, especially where rates are and the trajectory we see for rates over the coming months and years.
It's been pretty hard to be a fixed income guy as of late here. I am curious. I mean, we know investment grade certainly offers a lot of potential here, Gene. I am curious as to whether there's still any hope left here for that high yield trade that seemed to pay off for a lot of folks earlier this year.
Well, I think the big move in high yield is definitely behind us, but I still think there is value in a few areas within levered credit. First and foremost would be rising stars. So let's not forget that last year we saw one of the largest downgrade waves that we've seen, including the financial crisis. And there's still a lot of companies and industries where we can have meaningful upgrades back to investment grade. So I would put energy, autos, food and beverage, just to name a few, as industries where we could see a meaningful amount of credit upgrades, and there could still be price appreciation there. So that would put you at the higher quality end of high yield. I would also say within levered credit, we still think the leveraged loan space still makes some sense in this environment. Even though we're not in an environment of rising short-term interest rates, I think the alternative from a stability standpoint and the risk profile still makes leveraged loans attractive. I would put that into the context of a portfolio that as Matt said, would still be much more risk managed. I mean, let's be honest, valuations leave a little to be desired, but I think there is still opportunity in the high yield market in select areas.
All right. In conversation right now with Gene Tannuzzo, Columbia Threadneedle. Matt Diczok, of course, over at Bank of America Private Bank, Jeffrey Elswick, Frost Investment Advisors. Time now for the final spread. The week ahead, it is, of course, coming up. The U.S. pending home sales is going to be big. Coming up on Monday. That's followed by consumer confidence. That's coming up on Tuesday. And then look out for those Eurozone and U.S. PMIs out on Wednesday and on Thursday. Factory orders and durable goods. And, of course, rounding out the week, it's going to be the granddaddy of them all, of course, that payrolls report here for the U.S., a final payrolls report before that next Fed meeting, September 21st. 22nd. Of course, the labor market is front and center. Jay Powell, of course, talked about it and the substantial progress in moving towards full employment. Take a listen.
The pace of the recovery has exceeded expectations, with output surpassing its previous peak after only 4 quarters, less than half the time required following the Great Recession. As is typically the case, the recovery in employment has lagged that in output. Nonetheless, employment gains have also come faster than expected.
All right, a little subdued there, but you get the message here. Substantial further progress, I guess, has been made on inflation in his view. Has not necessarily met the criteria yet with regards to the labor market. And we sort of heard that echoed by Loretta Mester just a few minutes ago here, Matt. I am curious, when you look at the labor market part of the equation that Jay Powell seems to be hinging the start of the taper on, do you think we're going to get there this year?
Yes, I definitely do think we're going to get there this year. And actually, if you look at some of the numbers, a lot of people would say we're already there and we've been there for a while. Unemployment peaked at about 14.8% during COVID. We're now 5.4. I know we haven't got the labor force participation back yet. That is certainly substantial further progress as far as I'm concerned. One of the data points that we like to have pointed out, it's not new to the market, but it's interesting, is that you look at the recent JOLTS report in terms of job openings, more than 10 million job openings across the U.S. How many unemployed people do we have? Approximately 8.7 million. So you put those two together, there are 10 million job openings, 8.7 million people looking for a job, more job openings than jobs. To me, this tells me we have definitely met both the price stability and the getting closer, substantial further progress on both tests.
Yeah.
So in that case, what you want to have as central bankers, you want to have the optionality to be able to raise rates when you want. And right now, we're still a year and a half till they can raise rates. So I think you'd want to taper sooner rather than later. You want to shorten rather than lengthen the taper time period. Not that they're wrong. Their view is probably correct, but you want to always manage your portfolio. If you're a central banker, manage your policies to deal with risks.
Yeah.
And so you want to be able to raise rates sooner rather than later if the economy sets you up for that later this year.
Gene, your thoughts here specifically on the labor market part of this equation.
Well, I think this is an important piece of the conversation. The truth is, it doesn't matter if we think they've met the conditions. They just told us they think they have met the conditions to taper. What's more important to me is the line in the speech that there is a different and substantially more stringent test to in terms of what it takes to raise interest rates. So Powell did an interesting and very effective job, I think, at separating the taper from interest rate hikes. And I think it can help remind the market that last time around, it was a full 2 years in between when the Fed started tapering and when they first raised interest rates. And in that time frame, 10-year Treasury yields actually had a decline in yield of over a full percent. So I think it's a sobering reminder. And even though we would expect the taper, and it seems like the Fed has achieved its own threshold for that, the threshold for hiking is very, very different.
All right, Gene, I'm going to have to give you the last word there as we are out of time. Our apologies there to Jeffrey. You did get the first word, though. All three of you, of course. Wonderful to have you here on the program. Jeffrey Elswick there, Frost Investment Advisors. Matt Diczok, Bank of America. Gene Tannuzzo, Columbia Threadneedle. This is Bloomberg.